Welcome, everyone, to the latest episode of the Integrity 365 Financial Insights podcast. In light of this week's autumn budget announcement, we wanted to get together to discuss some of the key factors impacting financial planning for clients to be aware of. My name's Debbie Packer, and I am the founding financial advisor for Integrity 365, and I'm proudly joined today by my colleague, Craig Pritchard.
Thanks, Debbie. Yeah, hi everyone. My name's Craig Pritchard. I'm a corporate pension advisor at Integrity 365, and my role is to help employers and employees navigate pensions. So today we've got quite a lot to cover off from an individual and a corporate pension perspective, but I think the starting point, Debbie, is to cover off the implications for individuals.
Absolutely. And it was quite timely, actually, with the announcements being on Wednesday, just ahead of Halloween. We know there was a lot of scaremongering going on in the press leading up to the budget. We're fielding a lot of phone calls and conversations with clients who were, pretty concerned about what was going to come out and the potential tax implications on a number of areas. One thing that I would highlight is that there have been quite a lot of allowances and areas that haven't been affected that perhaps clients were concerned maybe, particularly with employed clients. We have been told throughout the budget that payslips will be unaffected. So people's main tax allowances and tax bandings are unchanged. They are still going to be frozen up until 2028, and then the unfreeze of those allowances will allow tax credits, tax allowances to increase by CPI going forward. There were quite a few areas. I've just made a few notes just to refer to, but there were quite a few areas, mainly on savings allowances. So, for example, ISA allowances are unchanged. So that's still a really valuable tax benefit, and that's the main ISA, junior ISA and lifetime ISA, although they have scrapped the British ISA, which I don't think many individuals took up, and we certainly didn't have a lot of inquiries around those. Tax bands are unchanged. They'll then unfreeze them. The savings bands are unchanged as well. But there was quite a lot of movement with employer tax and something that some of our corporate clients might face.
So yeah, over to me. So this is clearly national insurance and an area where the government are looking to raise a colossal amount of money over the next kind of 4 or 5 years, looking to achieve around about £25 billion. And pre kind of budget, there was speculation that employer NI would increase by around about 2%. In the end, they decided on an increase of 1.25%, so increasing employer national insurance to 15%. Okay, so that's the kind of headline rate, and this comes in from April of next year. But the second part, which is coming, which is quite a huge implication for employers as well, is the changes to the secondary threshold. So currently, employers pay national insurance at a rate of 13.8% on an employee's income above £9,100. What they've announced is that's now going to decrease to £5,000. So as a consequence of that, for an employee earning above, kind of £9,100 a year, there's an extra £600 employer national insurance just on the basis of the changes to the secondary threshold. Plus, you've got the extra 1.25% employer NI on top as well. So you can see this is a huge cost to employers, and I'm sure many of the employers that are on this call will be aware that that's going to have severe implications for employing individuals effectively. Just on the note of the secondary threshold reducing to 5,000, it will stay at 5,000 until April 2028, and then it will increase kind of in line with CPI beyond that. So it will change, but clearly a large reduction from where it is currently. So
Yeah,
we can see big change, and that's going to obviously have a huge impact in terms of the what it raises for the government, but from an employer perspective, couple that with the increase in national living wage, it's a circa of 6.7% increase. We can see there's an awful lot of pressure now being put onto employers to kind of help fund what the government are looking to, fund from a public sector perspective, fill in the black hole that we've all heard about, etc. So yeah, tough times for employers coming down the road for sure.
Yeah, absolutely. Is there any sort of help or assistance being given to maybe smaller companies?
Yeah, absolutely. Great point. So on that one, the employers do, or some employers are entitled to the employment allowance,
Yeah.
which has actually been increased from 5,000 to £10,500 from next April. So the government's own research indicates that around 865,000 employers, smaller employers, will benefit from that next year. So it will mean they won't kind of pay the NI. So there is help at the smaller end, but I think for the majority of employers, there isn't an easy way around it. The only one that really kind of springs to mind is salary exchange. That's an old favourite that we've all talked about. Salary exchange and salary sacrifice has been around for many years. Basically, what it means is when employers utilise salary exchange for their workplace pension scheme, they save NI on the value of the employee pension contributions. So at a time when NI is going to significantly increase, if you're an employer that's not using salary exchange at this point for pensions, I would say it's absolutely the time to revisit that, because this is a way of creating a saving. It's still advantageous for your eligible employees as well, but it's going to create a saving for you, which will help make a little bit of a dent in those increases that the government have announced.
Brilliant. Okay, no, that it sounds like there's some advice to be had in that section as well. Some help for our corporate clients out there. You mentioned pensions, Craig, and that obviously is the huge change that a lot of our clients will see. I know prior to the budget announcement, I was getting a lot of calls and a lot of questions around, relief on contributions and also tax-free cash. A lot of clients were saying, shall I take my tax-free cash now ahead of the budget? And, we managed to field a lot of those. Obviously, every client has a different circumstance, and what's right for one isn't always right for the other. But certainly, we did field a lot of questions around that. What has transpired, though, I think was something that less people were expecting, and that was the introduction of pension values from 2027, so from April 2027, that would fall into somebody's estate for inheritance tax. So that was something that, again, I don't think many clients really saw coming. So, on the positive, there's no change to tax relief. So, our higher rate tax paying clients or additional tax paying clients will still get full tax relief on their contributions at their highest marginal rate. The annual allowances are unchanged as well. So currently, subject to income and earnings, 60,000 is still the maximum annual allowance for a pension contribution. I know corporate clients as well have the value of putting pension contributions in through their company and doing it that way. So that is still a valuable way of tax saving. But obviously, we can't ignore the fact that if pensions are suddenly going to be taken into a client's estate for inheritance tax, that is going to create sort of a big revenue. And it was tabled in the budget announcement that it's £5.44 billion that the current government plan to raise over the next 4 years, which again is a big number, and obviously they're looking to use some of that to fill that black hole that's raised from pension funds and pension death benefits being included in inheritance tax calculations. And it also includes the reform on agricultural and business property relief as well that was mentioned, as well as maintaining the current IHT thresholds. It's quite a lot to think about there.
And Debbie, just on the pensions and IHT, my understanding is there's a 12-week consultation period now, which is going to end on the 22nd of January. So this is the opportunity to consult on how the processes that will be used to kind of implement this. Now, obviously, that's going to, when the final detail will come out. Are you aware of that consultation and any views on that?
Yeah, so again, it'll be really interesting to see what comes out from that, because at the moment it is just a proposal. There were wider documents circulated after the announcements in the budget. It's quite interesting how they're looking to bring in that calculation, because at the moment there is a lot of reliance on pension providers assisting in that. So the outlined plan is that the legal personal representatives for an estate would contact the pension provider for a date of death valuation. And then with that, they would then go to HMRC. Now, HMRC are going to be building a new tool as part of their probate pack And the legal personal representatives are going to be then inputting the date of death value, at which point then HMRC will give a number, give a value of the amount of inheritance tax that is due from the pension. So they will split the allowance between other assets and pension assets. And then it will be down to the pension provider to, at the moment, pay the inheritance tax. And then essentially that, that could take a lot of time. So, we'll see what comes out of that consultation papers, because obviously that's a lot of pressure and a lot more administration on the pension providers. And again, then the net value will be passed on to the member. So there's a lot, I think, to work through in terms of how that's going to play out. And of course, who knows what could happen. It's a consultation paper. They've proposed it. They are very assumptive it's coming in. So it's just how they implement it, I think, is the key factor. But obviously, we've got until April 27 until that comes in.
But it kind of strikes me that, you guys on the individual side, you're going to be kind of key elements of this in terms of supporting the deceased family and helping to make sure that the right information is gathered to get the right values and the right levels of taxes paid, because you wouldn't want to be reliant on a provider who isn't necessarily kind of privy to the full kind of estate background and value, would you? I guess ultimately that's where you guys add
Absolutely,
value.
yeah. Administration with all of this, Craig, is definitely key. Making sure that the providers, are aware of everything and have the means to actually support our clients when they need the most. And we're obviously there to help with the advice along the way. I mean, just as I said earlier, a lot of the allowances haven't changed. So there's still a lot of allowances available, the out of income exemption, the small gifts exemption, the gifts, lifetime gifts, exempt transfers. There's a lot of ways clients can protect the value within their estate. I do think things like bonds are going to be a lot more prevalent, and also trust planning. We also work with our legal clients on family investment companies, and things like that are going to be perhaps a lot more important if you suddenly bring the value of people's pensions into inheritance tax calculations. The other area that we can look at as well in time is, protecting what potential liabilities are there, and passing on wealth that way via life insurance plans in trust to beneficiaries. So there's lots of tools in our kit bag that myself and you and colleagues can talk to our clients about. But I think never more so, the landscape is getting more complicated, not less so. And financial advice really is key to make sure that everybody makes full use of those allowances, or at least is aware of them, so they can if they wish to. But again, just for the corporate clients on our call, Craig, that are obviously looking for ways, salary sacrifice sounds still like it's the winning formula for a lot of businesses. Is there anything else that our corporate clients could be doing now, or anything that you took away from the budget
Yeah.
announcements?
Yeah, and also I think for me, it kind of reinforces just that last conversation we just had for the last couple of minutes there. It's around about education. Pensions are a complex subject. They don't get any easier with changes that the government bring along. And that's where people need to be educated and they need guidance as a minimum. And for some, it will be, proper advice. But I think that's where we're seeing increased employers now wanting to educate their staff around their pensions. So, I've been pretty busy in the last couple of weeks doing kind of pension clinics, pension webinars. And this is the kind of detail that we're talking about today, not at such high detailed level, where we could talk to individuals, because the average Joe public in the street, they just see the headline on the news, pensions, they see pensions are going to be taxed. They don't fully understand the implications of it. And the risk with that is that has the adverse effect that people think, well, okay, maybe pensions aren't the way to save anymore. And clearly they're still hugely tax efficient, as you said. Nothing's changed from a rate perspective. Where else are you going to turn, £100 into £125 or more, depending on your tax relief. So, it absolutely makes sense to still fund your pension, but it goes back to education. And I think that's where employers can support their employees really by working with advisors to make sure that people have the information they need to make proper informed decisions, and not dare I say it, short-term decisions which might have an adverse effect on their retirement standings further down the road.
Yeah, absolutely. And the one thing that sort of rings true is those allowances, those reliefs that haven't changed, that everybody was so nervous about being scrapped, they are still the same. Capital gains tax as well. There was talk, it was leaked in the press that they were going to go up and equalize income tax rates, and they haven't. So again, making sure people use their allowances, capital gains tax allowance, we know it's reduced massively over recent times, but everybody still has £3,000 for the current tax year, and that's still unchanged. So again, that's a valuable benefit. The rates for capital gains tax, so with immediate effect, so they haven't even waited until next tax year, but with immediate effect, that basic rate, capital gains tax rate has gone up from 10% to 18% for basic rate taxpayers, and for higher rate taxpayers, it's gone up from 20% up to 24%. So, that probably doesn't feel like quite such a huge shift in terms of what people were nervously anticipating and what's actually come to bear. So, as I say, I think we can take a small sigh of relief. It's really just around that pensions, the NI contributions, it's all that side that's going to have, I think, the biggest impact. And making sure that people use their nil rate bands, making sure people are aware of what reliefs are out there, and use them all accordingly. There's a lot of planning that we can do. And I know you're busy talking to our corporate clients on all of the things they can help for themselves, their business, and their employees.
Yeah, absolutely. So, the inbox has been pretty full pre and post budget, to be quite honest. So no sign of slowing up really. And I think just a couple of the other kind of takeaways, I guess, from a pension perspective is, the state pension, obviously increases, not obviously, but it increases annually in line with kind of the triple lock protection. So as a result of the measures used, that's going to go up in line with the rate of average earnings. So it's going to increase at a rate of 4.1%. So for someone with a full state pension entitlement, their state pension is going to be around about £230 a week from next April. So that's a healthy increase, albeit kind of coupled with the changes to the winter fuel allowance, clearly that was previously announced. We talked about minimum wage. I've spoken to a lot of clients in the last few days, and they're really concerned about the additional kind of financial burden being placed on them as employers. And I think some of that will stem from the increase in the national living wage. We've had significant increases under the previous government in recent years. We've now got a further increase announced of 6.7%. So we're looking at a rate kind of now of 12.21 per hour. And that's challenging for an employer because, obviously at the lower end where someone is paid at minimum wage, you have to increase them by 6.7%. But it has that knock-on effect throughout the organisation because what do you do? What do you then do? Do you maintain that margin for people that are earning over and above that level? And that puts a huge financial cost onto the company. So yeah, I think, HR, FDs, are going to be kind of having quite a few challenges and interesting debates, I would suggest, in the next 6 months or so, working out their kind of remuneration strategy going into next year to kind of factor in the effect, not just of the NI, but national living wage increases as well. So that's a big area we're definitely going to be seeing. A couple of other things as well with pensions is that the government have committed to undertaking a whole review of pensions. So just to be clear, this is kind of in two parts really. Firstly, is to try to get more investment into the UK economy. So there is trillions and trillions and trillions of pounds in defined contribution or money purchase pension schemes, or should we say workplace pension schemes. Most of that is invested overseas in overseas equities. The government want to kind of tap into that. So, they'll be looking at ways to try to encourage or maybe force pension fund managers to invest into UK infrastructure, UK projects, etc., because that could help stimulate the kind of economy. And I know kind of Keir Starmer was over in Australia recently, and he was talking to some of the kind of heads of the superannuation schemes over there. So that kind of gives you a bit of a direction of travel. Maybe they're looking at how Australia have managed to do that and how they tap into those resources to fund their kind of, get their economy going. So that's one area to look at. And the second part, as part of this review, is all around pension adequacy. So, you'll know better than me that when you're talking to individuals about pensions, it's all about what is it going to give them in retirement? Is it sufficient? Is it going to meet their needs, give them the standard of living they want in retirement? And the reality is, at the moment, under automatic enrolment, 8% of somebody's earnings going into a pension isn't going to cut it. So, there will be that revisit, I suggest at some point longer term, not immediate, of looking at auto enrollment rates of contribution. So driving that rate up from 8%. We've already had royal assent and commitment that at some point automatic enrollment will change for lower earning and younger people, with the earliest age that people are enrolled dropping from 22 down to 18. And likewise, something called qualifying earnings, which is the minimum basis that can be used for pensionable salary, whereby the first £6,200 broadly of salary is not pensionable. That will go, and pound one will become pensionable. But that is significant because lots and lots of employers use qualifying earnings. So take, I don't know, the hospitality sector maybe, where they use qualifying earnings a great deal. If pound one becomes pensionable, that represents an extra £187 per annum employer pension contribution per employee. So if you've got hundreds, thousands of employees, that's a big increase on top of all the things that we've talked about today. So, lots more to come from a pension perspective, both kind of corporate and individual. So, yeah, I think we'll be both kept pretty busy, Debbie, that's for sure.
Yeah, I definitely agree with that. No, that's really really interesting, and I think coupled with that, you mentioned about pensions. I think that's perhaps the biggest takeaway that I've had on the personal side. I mean, we know state pension is a big burden in terms of cost to the state. We know it's not pre-funded. We know that a lot of these NI contributions are going to foot the bill of that triple lock and that protection of state pension, but we also know that the age is being pushed ever upward. And that's really why it's so important that clients do make their own personal provisions, with personal pensions, be that a SIP, a SAS, whatever form of personal pension somebody has. We know that they can access that 10 years prior to their natural state pension age. So if the state pension age is going up, then so is their access to their private pension as well. So again, really important that the provisions are made. And if there are going to be additional sort of tax burdens later on, then really just making sure that all of those allowances, the ISAs, bonds are looked at as well, capital gains tax, all of those significant allowances that people can use, we'll be focusing on at reviews and upcoming client meetings. So no, that's been really helpful. I do think we've covered quite a lot of the key areas and client concerns today. Obviously, if anybody listening has any further questions or would like to speak further to any of the advisors here at Integrity 365, please do get in touch. We will be closely monitoring, obviously, all of the developments. As Craig mentioned earlier, there is a consultation paper in place currently. We know some of these plans don't get implemented until 26 or 27, depending on the scheme. So again, we will keep a close eye on everything. So please do stay tuned for any further developments. You can also download a copy of our autumn budget summary guide, which is available via our website. And for more insights from our team of advisors, you can also watch further podcast episodes on YouTube or listen in via Spotify. So thank you all for listening. And thank you so much for joining me, Craig. I think it's been quite insightful, and I think we've got a lot more to cover in the future.
Absolutely. Thank you.
Thanks.